Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we will be discussing Fundamental Analysis Economic Indicators Part 2. Professional traders plan ahead, and you should too. Whether you are an institutional trader with a long-term view or an intraday retail Forex trader looking to scalp a few pips here and there, it is absolutely necessary that you plan in advance by looking at your economic calendar in order that you do not inadvertently trade at times of potential increased volatility. In example A, on Monday 13th January 2020, we can see from our economic calendar that there is a slew of data pertaining to the British economy, which is due to be released in the market at 9:30 AM GMT. This data is considered to be low to medium importance and covers things such as total business investments year on year, the trade balance and the industrial production month to month, which is of medium importance, and gross domestic product month to month, which is also of medium importance. In example B, which is a 1-hour chart of the GBPUSD pair, you can see that there has been a sell-off in the pair in the run-up to these figures being released. This is somewhat due to the fact that the last few days the Bank of England has been quite dovish regarding future growth of the British economy. This, plus strong hints that they may reduce interest rates by half a point at the end of the year. Therefore, traders are on the back foot while expecting that the British economy will continue to slow down, and they will be sensitive to any data releases that point to a weakening of the economy, which will provide further ammunition for policymakers in the Bank of England to reduce interest rates in the United Kingdom. In example C, our economic calendar, just a moment after the data has been released, we can see that the figures across the board are largely worse than expected, with the most important figure, which is the gross domestic product month on month, showing a worse than expected decline of -0.3%. In example D, we have returned to the 1-hour chart of the GBPUSD, and we can see that there was a further spike lower in the pair post-announcement of the economic data release. However, we often find in the Forex market that institutional traders will have anticipated the market data may have been worse than expected, and in some circumstances, even the economic data release is bad for the economy. This may be perceived by traders as not being as bad as expected. If we stick with the example for one moment, we can see that the overall trend has been to the downside with this pair. Therefore, new traders should have been on their guard because the pair may have bottomed out, even though there was bad data and a set for a reversal in price action. And this is one of the dangers when it comes to trading around economic data releases. In example E, we return just 4 hours later to our hourly chart of the GBPUSD pair, and when we can see that indeed price action has bottomed out, because traders had anticipated that all of the bad news was already in the price, and they decided to buy the pair. In part 3, we will be looking at different types of economic indicators and their importance to the financial markets. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.